this edition of It's Your Business, we have Gene Goldman. He's the Chief Investment Officer and Director of Research for Cetera. You think of investments and Cetera Investment Management, just a great name, I have to say that. And there's so much to talk about when we look at where we are for this mid-market, mid-year review, I should say. When we look at the markets, and we've talked about this a ton on the show, the concerns about U.S., China, and the trade dispute that's going on, the tariffs, et cetera. So, Gene, thanks so much for coming on the show. We appreciate it.
Thank you, Kate. Great to talk to you.
Let's talk about, before we get into the whole China thing and what's going on with our current market situation, let's talk about what you see, because I know people are glued to this. Where do you see markets headed for the rest of this year? And then, of course, as we bounce into 2020?
Sure. I think, obviously with the markets, I only have one crystal ball. I don't have 20 crystal balls. So I can't tell you exactly where we're going. But what I do believe that the one thing we can definitely say will happen is increasing market volatility. We've been lucky this year. Yes, May was a little volatile. Yes, we had some volatility in the fourth quarter of last year, but we do expect volatility to pick up, especially as we see what we call mixed signals in the markets. And this is the title of our mid-year outlook. You look at some of the data. Economic data is cooling down, but we're still in expansionary territory. Valuations are okay, they're fair, but earnings could weaken in the second and third quarter. And then you look at the Treasury yield curve. Yields are inverted. That means short-term yields are higher than long-term yields. And that suggests that there's concerns about the economy down the road. But at the same time, riskier debt in fixed income, riskier bonds are suggesting great times ahead. So it's a very much of a time of mixed signals to the market right now, which will create lots of market volatility.
All right, so there you go. So something to watch. So what are some of those key forces that are pushing us in these directions that you just mentioned for the current market situation? And you gave us some of that, but what else can we throw in there?
Sure. Let me just take the big one. So you can look at, let's take the U.S. On the positive side, we've got some great economic data. Unemployment is at a 50-year low. We also have more jobs. We have 1.6 million more jobs than people looking for jobs. We've had this, more jobs than people looking for jobs for 14 straight months. Consumers are confident. Retail sales are okay. Some good data there. On the negative side, you have lots of turmoil in Europe. Europe is under pressure from a data standpoint. We saw a data point that came out today. German business confidence fell to its lowest level since November of 2014. We also have European GDP at 1.6%. Remember, our first quarter GDP was 3.2%. And then, of course, you have China. You've got China, just this overhang, this trade war between us and China. That's really going to put a damper on the market. The good news through all of this is that the Fed is on our side. Jerome Powell, in the most recent meeting, has come out and he has said that interest rates will change when appropriate. That's a positive sign for the markets.
Boy, that sure is. And once again, we're speaking with Gene Goldman from Cetera. And as we continue down this road, looking at the mid-year market outlook, and if you're an investor and you're listening to this, and so some of what you said was positive, 50-year low for unemployment. Should people feel optimistic, do you think? And I'm asking you to pull out one of those hundreds of crystal balls, but what do you think, Gene?
Should we feel optimistic? I think so. I think, and I would say maybe cautiously optimistic might be a better term. I think, yes, unemployment is very low. Yes, consumers are doing really well. But again, at the end of the day, we have these overhangs. We have got the trade war. Manufacturing data is at a 2-year low. Things we need to consider. I think the biggest catalyst we need is the trade war to be resolved. And I think that's an important point for where the markets go for the balance of the year.
Yeah. And so when we look at that, we look at the U.S. economy and the trade tariff situation that we talked about, and you would have to think that there would be a little bit of a ping because of that. And we can't control what happens in these negotiations with China, but I think that's why, obviously, we have to pay close attention to it. And it's one of the things that you certainly, I'm sure, as you look at what's going on, look at it, Cetera, right? Everything that could possibly affect the markets.
Definitely. And, The trade war is important. You look at the trade war. We believe that there's three reasons why it will end soon. Why it will be resolved soon. Number one, as you and I have talked to, economic data has definitely weakened on both sides on our side and on the Chinese side. Number two, you see the effect on the stock market. So again, as I mentioned in May, as trade war rhetoric increased, we saw weakness in the U.S. stock market in May, and we all know that President Trump uses the stock market as a real-time indicator of how he's doing in the economy, how he's doing from an approval rating standpoint. The third point, I think the biggest reason why we do have an advantage over China is demographics. The fallout from the one-child policy has really, really pressured the Chinese economy. Case in point, 2017, lowest birth rate in China since 1961. This creates an aging population, hampers Chinese officials' ability to convert from a manufacturing to a consumer-driven economy like the U.S. And then you have the trade war on top of this. It's really causing pressure on the Chinese side. So this is why we view a resolution being resolved pretty soon, which should be good for the markets.
Yeah, I agree with you. I'm glad you brought up the low birth rate because that definitely has affected things in China. There's no question about it. So you have a lot of experience, obviously, Gene, in this game, 24 plus years of experience in the development of investment strategies. So as you look at what's happened with your career and the ups and downs and the flows of the market and talking about crystal balls and all that kind of thing, I think there's reason to be optimistic because of the game and the opportunities that are there and the capitalism that flows still in this country. What do you think?
No, I truly believe it. You look at, the long-term average for the S&P 500 since 1933 is about 9.3%. And 9.3%, yes, it's a volatile 9.3%, but the average return is 9.3%. This far outpaces average wage gain. So, the stock market's a great opportunity for you to invest in to complement your income. It's a great way to save for retirement. It's a great way to invest long term. Yes, there's times when you need to reduce risk. Right now we're telling our clients that, take a more balanced approach in your portfolio. Don't get too aggressive because, the markets are pricing in perfection right now. And as we've talked about, many times, things could just, derail this. So stay, balanced. Don't stick your neck out too far. Don't be too risky. But at the same time, don't go all out of cash because, the long-term average return is 9.3% in the market.
Woo, 9.3%. That's a pretty big number, Gene. So that makes sense. And you're talking about why position yourself a certain way in the market and to take that balanced approach makes complete sense to me. So we're talking with Gene Goldman, Chief Investment Officer and Director of Research at Syndicated Investment Management. All right, I got to ask you this one. What keeps you up at night?
Keeps me up at night. Obviously, the trade war. Obviously, tensions in Iran versus the United States, obviously Saudi Arabia. There's so many different concerns that keep us up at night. I think the biggest concern I have right now is Europe. Europe, you have growing populism, you have increasing debt to GDP levels, and this is causing pressure on the European economy. And the European economy, it could hurt our economy too. Case in point, you look at, German business confidence fell to its lowest levels since November 2014, as I mentioned before. GDP is lower. Industrial production has really weakened in Germany. Europe is having a tough time right now, and they've been trying to cut rates and been trying to get out of this. Case in point, you look at German yields. Get this, okay? Here in the United States, a 10-year Treasury trades about 2%. So that means I will borrow money from you and give you 2% in 10 years. In Germany, though, the same 10-year bond it's yielding negative 0.33. That means if I was going to borrow money from you in Germany for 10 years, you're going to have to give me money to borrow from you. Isn't that crazy?
That is crazy, and that's scary. So I can see why you would say that keeps you up at night, and that's something to certainly look at. I thought you were going to say like your favorite sports team wasn't doing so well.
As an original Bostonian, we've had some great times lately. So the Red Sox, Patriots, Celtics, Bruins.
Yeah, no kidding. I mean, it's too bad about the Bruins, but everything else was smooth sailing for you. And of course, now we go into training camps with the Patriots, and always if you look at any board anywhere, they're always picked to win the Super Bowl or get close to it, and this isn't going to be any different for them, I think. Gene Goldman, it was fun having you on. Thank you so much for joining us on the show. And we'll tell everyone they can go to Cetera.com for more information. That's with a C, Cetera. Thanks, Gene.
Thanks, Kate. Have a great day. Talk to you soon. Thank you so much.